Alright, so good afternoon and good morning to all of you. Today, what I will discuss is all about cost of capital. So, we are finished now with our discussion about capital budgeting. Alright, you know what last, no? When you say about capital budgeting, no? So, hindi mawawala, no? About the cost of capital. Okay, so lagi yan after your capital budgeting, we will discuss about the cost of capital. Alright. So what do you mean here of cost of capital? Okay. So when you say about cost of capital, no? So sabi nila, cost of capital defined as the rate of return necessary, to maintain the market value of the firm or the price of the firm's stocks. Again, the rate of return that is necessary to maintain the market value of the firm or the price of the firm's stocks. That's why here, class, no? When you say about cost of capital, it is also known as the minimum required rate of return. Yes, it is also known as the minimum required rate of return. Okay. So, mini class, no, when you say about the minimum required rate of return, saan ito ginagamit? Number one, for making capital budgeting decisions. Yes, ginagamit to class, di ba? In our net present value we're in, you will be able to compute for your present value of your cash flows. That's why we use our present value of 1 and the present value of annuity of 1. So hopefully, class, you still remember, no, about our discussion about our capital budgeting decisions. Okay, number 2. When you say about capital budgeting, class, no, or cost of capital, no, it is also used to establish our optimal capital structure. So we will discuss pa rin, no, the meaning or what do you mean of the optimal capital structure. And number 3, very important also, is that when you say about cost of capital, it is also used in leasing and bond refunding and the working capital management. So, yan, class, yung mga gamit natin, no, specifically in terms of computing or computing of your cost of capital. Okay. So, paano yan, sir? How do we compute for our cost of capital? When you say about cost of capital, now it is computed as the weighted average of the various components. Yes, no? Again, it is to be computed as the weighted average of the various components. Ng alin? Your debt, your preferred stocks, your common stocks, and your retained earnings. So that's your weighted average cost of capital. So it is the cost of your preferred, the cost of your debt, the cost of your retained earnings. By the way, class, ang tawag na ngayon sa preferred stock is now called preference shares, while your common stock, it is now called ordinary shares. Alright. So, what is, again, cost of capital? No? So, what is, again, the cost of capital? So, in the user's point of view, diba? It is the amount paid to suppliers of capital for the privilege of using their funds. Again, what is the keywords? If it is a user point of view, it is the amount paid to suppliers of capital, now, for the privilege of using their funds. While investors' point of view, it is the return generated and obtained from the return of your cost of capital. But in terms of the business point of view, yan ay combinations of the users and the investors. Again, in the users, ito yung binabayaran mo, the amount paid, while the investors is the return generated and obtained from the users of capital. And business point of view is the combinations of costs of doing, and at the same time, it is the return generated for employing your capital. Alright. Next one. So, how do we compute? No? So, we are now in the computations for the cost of capital. Since our discussion is more on the theoretical, at the same time today, we'll discuss also how do we compute for our cost of capital. No? So, each element of capital has its components, no, that is identified by the following. Again, class, ako lang yung gumawa nito, ha? Alright? So, ako lang yung gumawa nito, class, no? K, before tax cost of debt, KI, KE. Okay, bahala kayo, class, no? As long as for me, when you say about before tax cost of debt, it is a KI, while after tax cost of debt is the KD, is equals to the KI to be multiplied by 1 minus tax You have also here KP, or cost of preference shares. You have also here KS, or the cost of your retained earnings or internal equity. You have also here, you have KE, the cost of external equity. And also you have your KO, it is the firm's overall cost of capital, or the weighted average cost of capital. So yan class ha, yan ang ibig sabihin ng ating, or how we'll be able to compute, no, for our cost of capital. Alright, so next one, how do we compute for our cost of debt? Okay, please take note of this, no. So the cost of debt can be found by determining the internal rate of return, okay, on the bond cash flow. So yan class ang ibig sabihin ng ating cost of debt, no? The before tax cost of debt can be found by determining the IRR on the bond cash flow. That's why here class, please take note of the formula, no? What is the formula for the KI? It is I plus M minus V divided by N divided by M plus V divided by 2. Sir, anong ibig sabihin ng I? I is for the interest. M here is what you call par value, and usually it is a 1,000 per bond daw. When you say about V is the value or the net proceeds from the sale of the bond, and N naman is about term of the bonds in years. Okay, please take note of this now when you say about cost of debt. Alright, when you say about V as the net proceeds, it should be the market value minus any flotation or underpricing costs. Mamaya class, I will discuss the meaning of underpricing and your flotation cost. But the formula again is KI is equals to I plus you have your M minus V divided by N divided by M plus V divided by 2. So that's your cost of debt. For example, in computing for your cost of debt, but before that, please take note of this. When you compute for your cost of debt, it should be net of tax. Again, when you compute for the cost of debt, it should be net of tax. Why net of tax? Because cost of debt or the debt involves interest expense. And the interest expense is part of your income statement, di ba? Yes. Since it is part of the income statement, yung expense natin doon ay will become part of your income statement. And your expense is subject to tax. That's why the interest payments are tax deductible. The costs of debt must be stated on after-tax basis. And the after-tax cost of debt is KD is equals to KI just multiplied by 1 minus tax. Alright, sige nga class. So example natin class. So example for this one, cost of debt. Assume that the Carter Company issues a 1,000 8% 20% bond whose net proceeds are 940. The tax rate is at 40%. Then before tax cost of debt is again KI is equals to I. I here is your interest. So meaning to say 1,000 times 8%, you have 80. And usually, diba, M is usually the par value of the bond, which is at 1,000. And the 940 here is that market value minus flotation cost or any underpricing cost. Just divide it by 20 because the bond is at 20 here. Divided by 1 plus 940. And the 2 here is average, meaning it is a constant. So, meron to si class, the KI here is 83 divided by 970. The answer here is at 8.56. Question, is the 8.56 is your answer already? Very good. The answer is no. Why? Because again, the cost of debt should be net of tax. Therefore, the after-tax cost of debt is KD is equals to KI to be multiplied by 1 minus T. So you have KD is equals to 8.56 to be multiplied by 1 minus 0.40. So KD is equals to 5.14. Meaning to say class, the 5.14 is your answer in the cost of debt, not before tax cost of debt. Alright, very good class now. Next one is all about cost of preference shares. So what is the cost of preference shares? So the cost of the preference shares is found by dividing the annual preferred stock dividends. So let's say you have your DP, no? By the net proceeds from the sale of the preferred stock as follows. So again, what is the formula for this one? Cost of preference shares or the preferred stock is that you divide the annual preferred stock dividends by your net proceeds. Again, how do we compute for the net proceeds? It is the market value minus flotation cost minus underpricing cost. Mamaya, I will discuss the meaning of flotation cost and or underpricing cost. Okay. Please take note of the last bullet. Now, since the preferred stock dividends now are not tax deductible, alright, expense, these dividends are paid out after tax. Okay? Meaning class, there would be no adjustment is required in your cost of preference. Bakit? In layman's term, your dividends is not part of the income statement. If it is not part of the income statement, they are not tax deductible, di ba? Wala naman dividends in your income statement. That's why no tax adjustment is required. So meaning to say, kung ano yung na-compute natin in the cost of preference shares, ayan na yung answer natin in computing for the cost of preference shares. Very good. Okay, so suppose that the Carter Company has preferred stock that pays a 13 pesos dividend per share and sells for 100 pesos per share in the market. Okay na? There would be a flotation cost na naman, ha? The flotation or underpricing cost, please take note, is at 3 pesos or at 3%. Thus, the cost of preferred stock is KP is equals to DP. Your DP here is you have 13 divided by 97. 97 here is your net proceeds of 97 is equals to 13.4%. Meaning to say, class, the 13.4% here is what? That's now your cost of preference shares. Again, my question sa inyo, class, is 13.4% is already your answer? Very good. 13.4 is already your answer because it is not subject to tax. Because again, dividends is not part of your income statement. Thus, we will not compute for net of tax in computing for your preferences. Thank you very much. Now, next one. Next one is all about cost of equity. Alright, so ano bang ibig sabihin, class, ng cost of equity? Alright. It is also known as pala the cost of ordinary shares. So the cost of the common stock, K, is generally viewed as the return on the investors require on the firm's common stock. So it is more on the return on your common stocks. So there are three methods or techniques for measuring our cost of common stock. So paano yan, sir? So number one, also it can be using your Gordon's growth model. Okay, so usual to class now. In the Gordon's growth model, you can also do a capital asset pricing model, or you can also do a bond plus approach model. Okay, so we will do one by one now. So what do you mean here of Gordon's growth model? Okay, so number one, Gordon's growth model. If you notice, class, parang same lang siya kanina sa formula in the cost of preference, not in the dividends divided by your proceeds. But in the cost of equity, in the Gordon's growth model, it should be dividend for or to be received in 1 year. So meaning, class, it is future. Ano pa ang bago in the cost of equity? There would be what you call G or your growth rate. Class, yan yung bago, particularly in terms of computing your cost of equity. Alright, so where P0 again is the value of your ordinary shares, while D1 is the dividends to be received in 1 year, while KE is your cost of capital, and G here is the rate of growth assumed to be constant over time. So that's your Gordon's growth model. Alright. So for sample class, in a Gordon's growth model, example, assume that the market price of the Carter's companies is at 40 pesos. Alright, the dividend to be paid at the end of the coming year is at 4. Alright, and the expected to grow at a constant annual rate of 6%. Alright, and the cost of the common stock is as follows. Okay, again, KE is equals to dividend 1 divided by P0 plus G. So again, what is your dividend 1? Please take note of the dividend. It should be dividend coming for coming year, or dividend to be received in 1 year, not the dividend in the past. So it is 4 pesos. Just divide it by 40. Again, when you say about 40 here, it is the market value minus net proceeds. Sorry, not market value minus flotation cost minus underpricing cost, and that's your net proceeds. Okay, and plus G, and the G here is at 6%. Okay, I will not discuss now what do you mean of flotation cost and underpricing cost. It is the cost wherein the cost in issuing your stocks. In other words, class, when you say about flotation or underpricing cost, that's the cost in terms of or transaction cost of issuing stocks. That's why it is to be deductible. In other words, we have what you call commission, pagbabayad sa mga broker. Yan ang ibig sabihin, class, ng flotation or underpricing cost. Kaya nga, class, yan ay to be deducted, alright, in our 40. No? So, okay. Alright. So, cost of equity capital in the Gordon's growth model. Okay. Ito, class, ha? The cost of the new common stock or external equity capital is higher than the cost of existing common stock, no? Of the flotation cost involved in selling, alright, in selling the new common stock. If F is flotation cost in percent, the formula for the cost of the new common stock is KE is equals to D1 divided by P0 1 minus F or flotation cost plus your G. So that's the formula, class. So meaning, class, we will deduct our flotation cost. Yes, we will deduct any flotation cost because that's the cost of yun yung cost natin, no? Specifically of issuing our shares. Alright. For example, in the Gordon's growth model, assume that the same data except that the firm is trying to sell the new issues of stock A and its flotation cost is at 10%. Alright, so KE is equals to D1 divided by P0 to be multiplied by 1 minus F plus DR. Please take note of your KE now. It is now to be deducted in terms of your flotation cost. So, we will deduct any flotation cost. So, mean, class 4 divided by 40. Pero yung 40, class, ay to be multiplied by the net of tax. And you have plus 6%, meaning to say, under Gordon's growth model, the answer here is at 17.11%. Yes, class. So, you have 17.11%. Alright. So, we are finished na, no? With the Gordon's growth model. Again, kung may flotation cost, it is to be deducted. Number 2 method, in terms of your cost of equity, is your capital asset pricing model. Hopefully, class, you still remember about your capital asset pricing model, no? Okay, it's only a review. Okay. Capital asset pricing model is also part of your risk and return. Okay. So, an alternative approach to measure your cost of common stock is to use your capital asset pricing model. Alright, so how do we compute for the CAPM model? Number 1, we should estimate first our risk-free rate, or your what you call RF. And number 2, estimate the stock's beta coefficient. So you have your beta. Okay, so we will compute for the beta coefficient although given naman siya lagi, what we will compute is the return, which is the index of systematic or non-diversifiable market risk. So, we will discuss again, no, the meaning of a systematic or a non-diversifiable market risk. Okay, so when we are now in the risk and return, I will discuss the meaning of it, no, the systematic or non-diversifiable market risk. Number 3, estimate the rate of return on your market portfolio. Yes, no, so estimate the rate of return on the market portfolio. And number 4 is about estimate the required rate of return on the firm's stocks using the capital asset pricing model, or what you call SML equation. How do we compute for the cost of equity? It is the KE, or the cost of equity, is equal to the risk-free rate plus your beta to be multiplied by the market return minus RF. By the way, okay, ano nga yung class KE? KE here is the cost of equity. When you say RF, that's your risk-free rate. Meaning class, when you say about risk-free rate, walang risk, kaya nga risk-free. Okay? The beta here, in B, parang B, the beta here is what you call beta coefficient, wherein it is to measure your risk of systematic or non-diversifiable systematic risk. Again, what do you mean of systematic or non-diversifiable risk? Pag sinabing systematic, yan yung market-related risk beyond your control. That's why in the cost of equity, what we are computing is the beta coefficient of a systematic or non-diversifiable, kasi hindi mo siya makokontrol. Yes. And how about the RM? The RM here is the market return, that's the return of your market, and RF again is your risk-free rate. By the way, class, RM minus RF is what you call risk premium. Yes. It's also known as your risk premium. Okay, so how do we compute for the CAPM again? So in terms of the CAPM, assume that the RF is the 7%, is at 1.5%, and the RM naman is at 13%. Okay. So again, the KE again is that RF is equals is plus beta to be multiplied by RM minus RF. All right. So minute to say class, in terms of this, no, so 7% is your risk-free rate. How about the beta? The beta here is about 1.5, and the RM as the market return is at 13%, and the RF naman is at risk-free rate is equals to 16%. So that's So the answer here is at 6%. 16% here is the cost of the common stock, can be viewed as consisting of a 7% risk-free rate plus you have a 9% risk premium, which reflects that the firm stock price is at 1.5 more volatile than the market portfolio. Again, in terms of your cost of equity, it is attributable basically, no, to your non-diversifiable or systematic. So, but what class now? When we are now in our cost of equity, I will discuss this one. Okay. Number 3 approach, no, in the cost of equity capital is the bond plus approach. Now, how do we compute for the bond plus approach? Still another simple but useful approach is to determine the cost of your common stock is to add your risk premium to the firm owns equity. How do we compute for that one? No? This to be computed as KE is equals to long-term debt rate plus your risk premium. Please take note of your cost of equity, cost of debt wherein it should be net of tax. Kaya KI is equals to 1 minus T. And you add your risk premium. Okay. For sample class, this now is your data. So example, as the bond plus approach, long-term bond rate is at 5.14%, risk premium naman is about 4%, and the cost of common stock using the bond plus approach is, again, long-term debt should be net of tax, which is at 5.14. Then you add lang the risk premium of 4%. And you have now 9.14%. Okay. Sir, in terms of the board exam, ano ba ang usually Gordon's growth model and the capital asset pricing model? Wala pa ako nakikita about bond plus approach. Malay niya, ha? In your board exam, ay kasama na ang bond plus approach. Kaya nga, dapat alamin niyo yung class, no? Alright. Next one. So, we are finished the class of the cost of debt, cost of preference, cost of equity. We're in the cost of equity. We have our Gordon's growth model. We have our capital asset pricing model. And we have also about bond plus approach. Next is all about cost of retained earnings. Right? So, what is your cost of retained earnings? Please take note, no? The cost of your retained earnings is your KS is closely related to the cost of existing common stocks. Meaning class, magkaparehas daw ang formula ng cost of equity and the cost of retained earnings. Okay. So, since the cost of equity obtained by retained earnings is the same as the rate of return investors require on the firm common stock, therefore, cost of equity is equal to the cost of retained earnings. Meaning to say, class, in the cost of equity and the cost of retained earnings is that magkaparehas ang formula. Sino bang may-ari? Sino bang ang the right owner of the stockholders? Very good. The ordinary shareholder. Okay. Next question. Diba the formula for your cost of equity is dividend 1 divided by market value, or kung meron mang kung meron mang flotation cost, market value minus flotation cost under pricing cost plus G. Yan ba ang formula in terms of cost of retained earnings? Or the cost of RE should be dividend 1 divided by only the market value. We will not be able to minus our flotation or underpricing plus G. Very good, class. In terms of your cost of retained earnings, we will not include the flotation or underpricing cost sa pag-minus natin in our market value. Why? Because the cost of retained earnings, we are not issuing stocks. We are just accumulating our income. Hopefully, you naintindihan na about why the cost of retained earnings is we will not include any flotation and underpricing costs. Very good. Alright, so we are finished na about your cost of retained earnings. Okay. Next one naman is measuring the overall cost of capital. Okay. So, we are finished na. Again, what are the costs? Cost of debt, cost of preference, cost of ordinary shares, and the cost of retained. And now, our last topic is all about computing for your weighted average cost of capital. So, the firm overall cost of capital assets with the weights being the proportion of each type of capital used. Okay, so for example, case 0 naman is our cost of capital. Okay, sabi niya class, summation of your total structure supplied by each type of capital to be multiplied by the cost of capital each for each source of capital. So that's the formula, class, no, of our cost of capital. Okay. Ito rin, class, yung another formula. Kaya lang medyo malabo siya, don't worry. Nakahanap ako ng mas madali in order for us to know, no, in terms of computing your average cost of capital. So ito naman ay WACC plus C1 divided by TC K1. Okay. So you can use this one naman. Okay. But for me, ito yung pinakamadali, class, no? Okay. For example, you have your bonds, you have your loans, you have your preference shares, you have your common, and you have your retained earnings. Please take note of the bonds. You have 30%, loans of 20, preference of 10, common of 30, RE of 10. Just multiply it by our cost of capital. Yes, last, no? So just compute it for our in computing for our cost of capital. Okay. So just multiply it by the 12.025, 20% times 13.585. Then you have your 10% times 16.666. You have also here 30% times 25 and 10% times 25. Don't worry, class, ha? Meron naman tayong computations, no? About this one. Okay. And this one, how much is your average cost of capital? So the answer here is at 17.990. Again, don't worry, meron tayong explanation on how to compute for this one. Okay. Okay, to class. What if this is the one? No? So assume that the following capital structures for the Carter Company is as follows. No? You have your bonds, you have your 1,000 par, and you have 20,000. You have your preference shares, you have 100 par, and you have 5 million. You have your common at 40 par, you have 20 million. And also you have your retained earnings, and you have 5M. How much would be your capital total? You have 50 million. Please take note of that capital structure. Okay? That would be your capital structure. Okay. The value weight for this one, di ba yun yung kanina, yung book value. So, you have 20, you have 5, you have 20, you have 5. So, the weight here is 40, 10, 40, 10. Saan kanina yung 40? 20 million. Just divide it by 50 million. You have 40%. Your preference naman, you have 5 million. Just divide it by 50. You have 10%. Then you have 20 divided by 50. You have 40% again. 5 divided by 50, you have 10%. All in all, you have 100%. And the cost of this one is at 5.14, 13.40, 17.11, and the retained earnings is at 16%. Saan nanggaling ang 5.14, 13.40, 17.11, and 16? If you remember, yan yung kanina kinumpute natin about our cost of bonds, cost of preference shares, cost of ordinary shares, cost of retained earnings. Hopefully, naalala nyo pa yan. So, meaning to say, class, yung cost of each capital, ay yan yung ginawa natin. So, just multiply it by the weight of the capital structure. 40% times 5.14, 10 times 13.40, 40 times 17.11, and 10% times 16%. Okay. So, how much would be your weighted average cost of capital? Just add na lang. And the answer here is at 11.84%. So, almost, your cost of capital is at 12%. So, again, hopefully, naintindihan to, class, ha? Hopefully, you understand this lesson about cost of capital. By the way, this 11.84% or 12%, yan yung gagamitin natin, no? That percentage will be used in our capital budgeting, in our leasing, and in other computation in terms of present value. In computing for the present value of one or the present value of annuity of one. So again, thank you very much and hope to see you soon. Bye-bye.